China has been selling US Treasuries, not all at once, not as a panic move, but consistently, year after year, hundreds of billions reduced. At the same time, it stopped recycling dollars back into America. The dollars didn't disappear, they just didn't come back. They were converted into commodities, into supply chains, into bilateral trade, into systems that don't need the dollar. This didn't crash markets. It did something more dangerous. It removed the buyer that was always assumed. So the US didn't feel collapse. It felt pressure, more debt to absorb, fewer natural buyers, higher yields to compensate. This is what a liquidity shock looks like when it's done deliberately, quietly, and before the public is paying attention. Something feels wrong. Not broken, not dramatic, just off. Markets are still open, screens are still green some days, trades still clear, payments still settle. On the surface, everything works. But underneath, something is thinning. Liquidity is no longer where it used to be. Not gone, just less willing, less patient, less automatic. Treasury auctions don't feel effortless anymore. Dollar funding isn't taken for granted. Central banks speak more carefully than they used to. No panic, no headlines screaming collapse, just hesitation. Money that once moved instantly now pauses. Capital that once recycled smoothly now asks questions. Buyers that used to show up without thinking now demand compensation. This is not volatility. Volatility is loud. This is friction. And friction is quiet. It shows up as temporary adjustments, as technical issues, as market digestion. Nothing that sounds alarming. That's why most people ignore it. Because the system hasn't failed, it's just stopped being generous. For decades, liquidity felt infinite. There was always a bid, always a buyer, always someone on the other side of the trade. Now sometimes there isn't. Not because money disappeared, but because willingness did. That distinction matters. You don't feel this kind of shift all at once. You feel it in small inconveniences. Higher yields where there shouldn't be. Spreads that don't compress anymore. Interventions that work, but only briefly. Like pushing a door that used to swing open and now resists just enough to make you notice. Nobody rings an alarm for that, because alarms are for events. This is not an event. It's a condition. And conditions don't announce themselves. They reveal themselves slowly. By the time the public notices, the explanation is already framed incorrectly. They will blame policy. They will blame personalities. They will blame politics. They always do. But this discomfort did not start with a decision, or a speech, or a crisis. It started when the system crossed a threshold it couldn't uncross. When holding liquidity stopped being neutral, when storing value stopped feeling safe by default, when trust quietly began demanding a premium. No one talks about that moment, because it doesn't look like anything until much later. This is how every major shift begins, not with collapse, but with discomfort. And the most dangerous part is this: the system still looks strong enough that questioning it feels unnecessary. That's when the pattern is already active, before explanations, before blame, before panic. This is not the beginning. It's the signal that something much older has started moving again. This is not new. This has happened before. It happens the same way every time. The pattern does not adapt. It does not learn. It does not care. A currency becomes dominant, not by force at first, by convenience. Trade settles in it. Contracts reference it. Debt is priced in it. Reserves accumulate in it. The world begins to need it. The issuer gains privilege. Borrowing becomes easy. Interest feels optional. Deficits feel temporary. Expansion feels deserved. This phase always looks like success, but success is not stability. It is leverage being stretched. Every unit held abroad is a promise of future value. Those promises compound, faster than production, faster than savings, faster than reality. At first, nothing breaks. Confidence fills the gap. Liquidity smooths the math. Time delays consequences. This is the setup. It is not policy failure. It is structural inevitability. Rome did it with silver. Purity declined quietly. Circulation expanded loudly. Britain did it with sterling. Claims spread across the empire. Capacity shrank at home. The United States did it with dollars. Gold was the limit. Then the limit was removed. Different systems, same sequence. Once promises exceed backing, pressure builds. Not externally, internally. Servicing obligations becomes harder. Taxes cannot cover it. Growth cannot outrun it. Cuts are politically impossible. So currency creation fills the gap. At first as an exception, then as policy, then as habit. Liquidity replaces discipline, debt replaces savings. The system still functions, but its nature changes. Foreign holders notice erosion, not panic, calculation. Central banks reassess neutrality. Institutions rebalance exposure. No announcements are made, no exits are rushed. Capital does not flee, it simply hesitates. Recycling slows, reinvestment weakens, compensation must rise. This is the critical transition. Liquidity thins before trust collapses, always in this order. The population never sees it live. because nothing looks broken yet. By the time it does, the mechanism is complete. This is where the separation begins, not between countries, between awareness levels. Elites do not wait for collapse. They never have. They move before explanation, before consensus, before permission. They recognize the shift early, because they watch flows, not headlines, not narratives. Capital reacts first, always. When recycling slows, they notice. When bids weaken, they adjust. When liquidity hesitates, they reposition. Quietly, methodically, without announcement. This is not panic, it is optimization. Large pools of capital cannot exit suddenly, so they rotate. They shorten duration, they reduce exposure, they seek optionality. They favor assets that do not rely on promises. They prefer systems with exit flexibility. This has happened before. British capital left sterling assets before devaluation was admitted. German elites converted paper to real goods before hyperinflation was public. American institutions accumulated hard assets before Bretton Woods collapsed. The sequence never changes. First comes quiet reallocation, then comes narrative justification, then comes public reaction. The population never sees step one because it looks like normal behavior. Portfolio management, risk adjustment, diversification, nothing alarming. But the direction is consistent, away from long-term promises, away from fixed claims, away from systems requiring constant confidence, toward liquidity with control, toward assets with intrinsic value, toward jurisdictions with surplus, not deficit. This is the recognition phase, not of collapse, of transition. The system still functions, but insiders treat it differently. They no longer assume stability. They price fragility. They demand compensation. They keep exits open. This is not betrayal. It is pattern literacy. Those who understand structure do not argue with it. They adapt to it, silently. By the time the public asks why conditions changed, positioning is already finished. This is where the mechanism reaches now, not announced, not declared, already in motion. China does not act loudly. It never has. It does not sell everything at once. It does not trigger panic. It reduces exposure gradually. Treasuries decline year after year, not as protest, as positioning. Reserves are converted from paper to material, from promises to inputs, from claims to control. This is not dumping. It is withdrawal. At the same time, alternatives are built. Swap lines replace settlement. Local currencies replace dollars. Payment systems bypass legacy rails. Nothing breaks overnight. The system still clears, but demand weakens at the margin. That margin matters, because reserve systems survive on margins. The dollar does not collapse. It becomes more expensive to sustain. Higher yields are required. Stronger incentives are needed. Liquidity must be coaxed, not assumed. Japan feels pressure at home. The yen weakens. Policy tightens. Foreign assets are reconsidered. Selling becomes rational, not ideological. Europe prioritizes internal stability. Energy costs dominate decisions. Surpluses stay domestic. Emerging markets watch precedents. Assets can be frozen. Access can be revoked. Neutrality is questioned. Reserves are reassessed. No coordination is required. The incentives align on their own. Less accumulation, more diversification, more hedging, less automatic recycling into U.S. assets. This is the liquidity shock, not a crash, a thinning. Demand that once arrived without thought now negotiates. Buyers that once absorbed issuance now hesitate. The system responds with policy, rates adjust, facilities expand, backstops multiply. These actions stabilize function. They do not reverse structure, because structure is not policy dependent. It is incentive driven. China did not create this mechanism. It recognized it and moved accordingly. Others are following, not because of China, because the math is visible. This is not the beginning, it is the confirmation. This is where the pattern leaves the page and enters awareness, not as certainty, as discomfort. Nothing has collapsed. Nothing has failed publicly. The system still operates. Payments clear. Markets open. Institutions function. That is what makes this moment dangerous. Because collapse is obvious. Transition is not. The question is never whether the system survives. Systems always survive longer than expected. The question is who adapts first and who waits for confirmation. History answers this every time. Those who wait for clarity pay for it. Those who recognize structure move quietly. This is not about China. It never was. China is not the cause. It is the participant who acted earliest. Others are now responding, independently, rationally. Following incentives, not ideology. Reserve systems do not end in announcements. They end in indifference, when holding becomes optional, when recycling slows, when confidence requires compensation. By the time this feels obvious, the repositioning is finished. The assets are moved. The exits are priced in. The narratives arrive last. They always do. This is not prediction. This is pattern recognition. History does not repeat. It executes. The only question is whether you see it before it finishes.